Oh, yeah, we're doing this. We are live, about 9 minutes later than usual, but that is the life of a normal person who has normal things that come up. It's going to be a good show. The taper, the taper begins. Now what? Now what do we do? Let's talk about this. Let's get rid of this and join you for real. Hey, I'm Mitch Goldberg. Thank you so much for joining me. This is my live stream. We talk about investing, financial planning, personal finance. I really strive to put the personal into personal finance. There's no one size fits all. So we're going to talk about the taper. What does it mean? The stock market, interest rates. This is the big thing going on if you're a market watcher, a market participant. It's like all we could possibly talk about. So just want to get into this stuff with you. So let's roll a quick intro, and then got a good show. It's going to be quick. It's going to be interesting, and I love this stuff. So give me a thumbs up or something. Let me know you're out there, and here we go. Hey there, it's Mitch Goldberg. You're watching Be the Boss of Your Money because it's very easy, for your money to become the boss of you. People get in trouble with credit cards, too much debt. People underestimate how much taxes they're going to owe. They underestimate what their income will be in retirement, or they underestimate their expenses. And we often get things wrong. When it comes to money. And sometimes we turn a blind eye to things about money. Sometimes you just don't want to deal with it. But I want to put it front and center in a way where we could go through snackable, bite-sized bits of personal finance and help you be better with your money. That's why I call it Be the Boss of Your Money. I know it sounds a little hokey, Be the Boss of Your Money, but I really mean it. I want you to be the boss of your money. And I think it's an important distinction between getting by day to day, week to week, month to month with money, as opposed to building your net worth. So if you're just joining us, you're watching Be the Boss of Your Money. It's my live stream. It's your post-market live stream every day at 4:30, except for today we got started at 4:39. So I'm just going to tell you real quick. If you knew the day I had, you might not know this, but my mother was in the hospital for a few days. She's okay. Everything is okay. False alarms and stuff like that. I left my office at 2:30. Right now it's 4:42 as I'm speaking. I left my office at 2:30, picked her up all the way in Huntington Hospital. And she was not ready to be picked up. Sitting on lying in the bed with the hospital gown. I'm like, wow, I spoke with the staff and nothing. So they helped get her ready. We wheeled her down, got her in the car, went to my house, had something to eat, picked up her aid, and then I drove her back to her house, back into Huntington, and then back to my office. So it's like a minor miracle that I'm even doing this today, because look, don't you ever have days like that where like, you're just like, why did I even bother planning on doing something at such and such a time when my schedule is so full? But I am running. I'm good at running around real fast. I'm good at juggling. What can I say? So I'm here. I just want to share with you my day, why I'm a little bit late. I mean, from my office to Huntington Hospital, back to my house, back to Huntington, back to my office. And I did the whole thing in about 2 hours. It's remarkable. Helped get my mother ready to leave the hospital because she wasn't ready when I got there. Got something to eat. Yeah. All right. So this is the post-market show. If you have any questions, please hit me up in the comments. I love hearing from you. It could be about personal finance, mortgages, credit cards, spending, investing. Certainly the topics we're going to talk about today, the Fed taper and what comes next. What does it mean for your money? And, while you're watching this, if you don't mind, give it a thumbs up or a heart or a wow or an appreciation, whatever reaction you have, depending on what social media outlet you're watching from. Okay. And I really appreciate that. Plus, when you give it a reaction, I get to see who's out there. So we have Rianne. Rianne, I feel like I just saw you. Don't you feel like I feel like I just saw you like 5 minutes ago? So good to see you. Thank you, my friend. It's great you're out there. So let's get into the heart of the matter, and we want to look at U.S. markets. We're going to switch screens. Here we go. Cut to the screen. Okay, here I am up in the corner. Hey. So, in spite of everything and the worry, I'm going to make this a little bigger so you can see it on your smartphone. Okay. In spite of all the worry about the taper, the Dow was still up, record territory. NASDAQ was up. I think that's a record for the NASDAQ. Definitely another record for the S&P 500. Gold was down. And that's pretty significant. Oil is down, and that's pretty significant. I'll tell you why in a moment. The VIX is down. That's pretty significant. I'm going to have to go through all these things. The Russell 2000 was up 1.8%. That is pretty significant. So let's tackle these one at a time because listen to me. You're going to learn something here. I'm telling you. I'm telling you. You can hear me, right? I'm telling you. You're going to learn something. All right. First of all, the Fed has finally announced that they're tapering. So what the hell does that mean? During the pandemic, the Fed decided to buy $120 billion worth of bonds every month, of treasury bonds and mortgage bonds, to help keep the economy flush with cash, to help keep the financial services sector, the financial system moving along, keeps interest rates low, helps support borrowers, housing. If you support borrowers, it's like you're supporting growth, okay? And when there's borrowing in an economy, it's actually good for growth. It's when you stop the borrowing and have to pay the piper is when we have recessions, right? So $80 billion of treasuries and $40 billion a month of mortgage backs, $120 billion. The Fed said they're going to reduce what they're buying by $10 billion a month of treasuries. So 80 billion minus 8 billion, they'll be done in June. And $40 billion of mortgage backs, they'll reduce that by $5 billion a month. So, this month in October they bought 40 billion. So November they'll be buying 35 billion of mortgage bonds, and 30, then 25, and for the treasuries, the last month in October they bought 80 billion. So November they'll do 70 billion, and then 60 billion, and then 50, 40, 30, 20, 10, and be at zero in June. And that's pretty significant because it's finally the Fed is acknowledging that we're done providing the economy the help that we've provided it with stimulus. Now the economy has to basically say, hey, you're pretty much through the pandemic. You have to start functioning on your own, whatever the new normal is, whatever Delta surge or Epsilon surge or whatever. Does Epsilon come after Delta or is it Gamma? I don't really remember. I was in a fraternity in college, but I don't actually remember. So here we go. So this is significant because, the economy was flush with cash, and that's one of the things that kept asset prices going up, in particular, single-family homes, multifamily homes, and stocks and bonds. So I put out a note called "Don't Fear the Tape," like "Don't Fear the Reaper," with the Blue Oyster Cult album cover, but I crossed off Reaper and wrote in Taper. And so don't fear the taper. It's a non-event. This is like this is the most significant non-event like in the history of financial markets. Really just such a non-event. So the Fed's done a great job telegraphing this whole thing. So let me just make this comfortable. Yeah, we go. So the Fed has done a great job telegraphing this whole shebang. And now what would follow is rising interest rates. Rising interest rates is considered a much more serious end of stimulus. It's much more serious policy than ending the bond buying. So now we have to think about what's next because there's no rest for the weary. It's like, oh, finally got the taper over with. We could relax, take a vacation. Nothing to talk about anymore. You'd be wrong to think that. I think you know that. Because you have the employment figures for the month of October coming out this Friday. Today, the ADP report was like jobs created was huge today. So let's see if that translates into a positive non-farm payroll report on Friday. We still have to see what's going to happen with inflation and interest rates. The economists generally expect we'll see inflation slow down to about 4%, 4 or 5% next year, and 3% the next year. Jerome Powell, the chairman of the Federal Reserve, and the gentleman in this pic with me. Okay, you see that fellow with the glasses? Okay, he feels that inflation is still transitory and will moderate. And when he took pains to define transitory, like he said, we didn't mean transitory like 3 months or 6 months. We mean transitory like over the next year or 2 or 3 years, as we stumble past the supply shortages and the economy gets back on track, the world gets back to normal or the new normal. We're going to get back to oversupply. We're going to have too much of everything man-made and, mined and man-made. And inflation should moderate a lot. So that's why they're not so worried about it. Plus, the Fed has a dual mandate: full employment and managing prices, inflation for the American people. So there's still a ways to go. Let's take some comments out there. Okay, so we've got Steve. Will supply issues create okay. Will supply issues create stagflation? I don't think so. And I'll tell you why. For example, Ford is actually now increasing production because it appears that their chip shortage is actually it's actually improving a little bit. We will get through this stuff. So, and I'm not saying that, let's say, in the next year or two, we see GDP. I'm not saying that we could see GDP slow down a lot and inflation still linger pretty high. And that'll be textbook definition of stagflation. I don't think it'll last a long time. I mean, technically, we are in a state of stagflation right now because the GDP moderated a lot in the third quarter down to 2%, while inflation was going up. So technically, we are in a state of stagflation, but I don't think we're going into a state of stagflation anything like what we saw in the 70s, which is what most people think about when they think about stagflation. I was very young. I was born in 67, so I was a kid back then, so it didn't really mean that much to me. So no, I don't think it's a big problem. I think it'll be a temporary phenomenon. Okay. So thank you very much for commenting. So if you want to talk, but I want to get into this is why I said gold, I think, is a big deal. See, gold, all right, was down 16. You see that? Down 16. When the Fed starts to tighten policy, paying attention to inflation, gold is coming down. So that's I think investors who follow gold never really believed that inflation is a lasting problem. And based on the way the stock market has been, we talked about this a few times this week and last week. Based on the way gold has been trading and bonds have been trading, I don't think investors are really that concerned about a long-lasting period of inflation. And you could say, well, crypto is up. Crypto is up not just because of inflation. I mean, there's a big component of it is worries about currency debasement, just not taking care of our currency and printing too much of it willy-nilly style. But crypto is also gaining more acceptance with publicly traded companies, corporations, and it's just become very popular. And there's a finite amount of it, so it's going up for those reasons. In particular, I'm talking about Bitcoin. But no, I don't think the market's worried about inflation. And then you take a look at oil, and you see oil down almost $4, down almost 5%. That's pretty significant. I was talking today to a reporter at Newsday, a business reporter at Newsday, early afternoon, about we're actually going back and forth with email about tapering. And he said he's really interested in picking my brain about people investing in oil stocks of oil companies or oil itself as a hedge against higher fuel prices for consumers, for households. Aside from the fact that I think it's a terrible idea for households, mom and pop people to try to hedge their energy costs because energy could be so volatile. I mean, look at it, down 5% today. And I said that if the Fed, when the Fed tapers, that's probably going to hurt these reverse dollar kind of assets like gold and oil. When you start taking better care of a currency, it's very common to see gold and oil go down, which is exactly what happened today, by the way. So I think it's foolhardy for mom and pop investors to try to game the system by saying, "Oh, I'll buy oil stocks and get dividends from that, and I'm going to just make up all that money for when I'm paying extra this year in heating oil or natural gas." And I don't think I mean, if somebody's really impacted by a rise in energy costs, it's probably somebody who really can't afford to speculate on the price of energy with stocks or other derivatives or something like that anyway. So I highly recommend against it. If you believe an oil stock is part of your long-term investment portfolio that will help you meet your long-term goals, then by all means go for it. But that's a better way to look at it. The VIX, you see this over here? The VIX 15, we talk about that a lot. Under 20, the market rallies. The market continues to rally. The VIX has come down just about 6% today. And that's because there is a certain calmness coming from the Fed. Hey, you know what? We realize there's inflation. We're not going to try to squash it right now because we don't want to kill the economy. We want to see more improvement in the labor market. But we're aware of it, and we're taking some baby steps now to start to rein in cost inflation and to rein in the printing of dollars. And that's why you saw gold go down and oil go down today. All right. The fact that the Russell 2000, that's the small cap index, small cap stock index, the fact that that went up is a vote of confidence that investors expect the economy to do well because small cap stocks are much more sensitive to the vagaries of the U.S. domestic economy. Small companies are, their revenues are more domestic based, and they don't, they're more likely to borrow like from banks as opposed to issuing bonds like a large corporation would. Okay, so Philly, just go long, taper doesn't matter. They print trillions every year. Well, it doesn't look like they're going to be printing trillions after this year. You never know. But after the infrastructure package and the social spending packages, that's pretty much it. I don't think there's going to be any more appetite to get any major fiscal packages out the door. 5 trillion. If we get the social spending and the infrastructure out, let's say it's 2.5. That'll be about $7.5 trillion of spending in less than 2 years into the economy. I don't think we get anything after that. So enjoy it while it lasts, but those should be good for the market for a while is my expectation. So if you have any questions, bother, if you're just joining us, if you have any questions, hit me up in the comments. If you're just joining us, my name is Mitch. You're watching Be the Boss of Your Money. We're talking about the Fed taper today. So the Fed buys bonds every month, and they're going to buy less bonds every month until they're buying zero. That's tapering. They should just call it maybe the Fed bond reduction or something, but they decide I don't know where the name tapering, I know where it came from. It came from Ben Bernanke. He said he's going to taper bond purchases. Whatever, reduction, taper, all semantics, right? Until somebody gets hurt. So let's now focus on what comes next. The reason the market's holding up in the face of the taper of essentially the Fed saying we're remaining accommodative. It's less accommodative, but still accommodative by tapering. But it has nothing. The timing of the taper has nothing to do with. I want you to remember this with liftoff. Liftoff is the term given to when the Fed starts to raise interest rates. Right now, the federal funds rate is pegged between 0 and 0.25%. When does the Fed raise the Fed funds rate to a quarter point, which will be a quarter point to, let's say, 0.5%, and then 0.5%? Most investors expect the Fed to raise rates in the middle of next year and then maybe toward the end of next year. But we expect to see two rate increases. Some are saying three rate increases next year. Jerome Powell has taken painstaking steps to let us know that they have not begun the conversation at the Fed, at the Federal Reserve, in the Federal Open Market Committee. They have not begun the discussion of liftoff, of raising rates, and they want to see how this goes. And once they stop their bond purchases, which injects liquidity right into the economy, I think they want some space between next June and when they start raising rates. Now, inflation could keep rising; it could rise up like crazy, and then they'll jack up interest rates, or inflation could start to moderate, and supply chains could loosen up. All right, inflation could go down, and then the Fed will say we could take our time raising rates. Anything can happen, and that's why I think it's like foolhardy to make bets with your financial future based on what the Federal Reserve is going to do in the middle of 2022. The bottom line is if you're close to retirement, in retirement, and you've got too much money in the stock market, it's time to cut back on stocks and put that money into something else. And it's too bad if you don't get any interest in the bank. I'm not getting any interest in the bank. Bond rates are low. I hear this all day long. I have to get dividends. I'm safe. I'm going to dividend stocks. If the market goes down 40%, your dividend stock is going down too. It might not go down 40%, but it could go down 30 or 35%, which when you're like 75 years old and no longer have an active income and your portfolio takes a hit and you still have to take money out of your portfolio to pay your obligations, your financial obligations, that's called the negative sequence of returns. And that is a really bad position to be in, because when the market does come back, you won't even make the money back because you sold at lower prices and you locked in those lower prices. So make your decision based on personal finance, please, not based on you are thinking of what the Fed's going to do. We talk about the Fed. It's exciting. It's interesting. It's very important. But the Fed's moves more or less really dictate a very broad macro thing. The Fed could move the economy. It could slow down the economy. It could help speed up the economy. So that, I think, is a much bigger deal to most people than whether or not they should buy an energy stock or a tech stock. Now, if rates do go higher, that hurts high duration stocks, which are stocks that are considered to have high valuation metrics like high PE ratios or high price to sales ratios. And relatively speaking, it favors companies that are called value plays, which have lower metrics when it comes to financial valuation metrics. I just want to see who is out there. Jay is out there. Tiger is out there. And Rianne is out there. Thank you, guys. Good to see you, all of you. Coffee break. You guys have any questions about this? So we got through it. We got through the taper. We live to tell the story, and now we're gonna talk about now is when does the Fed raise interest rates, and we're gonna talk about it until we're blue in the face through the middle and third quarter of next year, so that by the time the Fed raises rates, we're going to be relieved that they finally did it, because we got so sick and tired of hearing about it. Just like what the Fed did with the taper. They beat this into our head for months, taper, until we finally got so bored of it. Now that it happened, it's a non-event. By the way, the Federal Reserve's balance sheet now has $8.5 trillion on it. Before the Great Recession that started in, let's say, in 07, late 07, the Fed had about $400 billion on its balance sheet. Yeah, so it's a lot, right? It's gone up a lot. There's a reason why there is not a personal finance TV show let me start by saying this. There is a reason why there's not a personal finance news channel, because it would be boring. Who would want to watch a show about watching paint dry? Because that's what personal finance is all about. It's about your little decisions based on your personal situation. Okay. It's about your spending and saving habits, like saving first before you spend, like putting money into a retirement plan right away when you get your paycheck, even before it hits your checking account. Those are the kinds of activities that build wealth for people over time. And I find that we are spending so much time, not you per se, but I feel people are spending so much time looking for the next hot SPAC or the next hot crypto. And people are just moving money from one speculative thing to the next because they're hoping to catch the wild ride and make up for previous decades of poor personal finance habits. And that is a really bad way to go. If you're in that position, watch my show so I can give you tips to help you get out of that position. But if you're not in that position, don't ever get in that position. Just realize that whatever the fad is today, and I do look at crypto and meme stocks as fads, it's going to change. And then we'll be into something else. And if you chase these, you're just going to wind up holding the bag in some worthless security or crypto. And you have nobody to blame but yourself. So don't worry about all this stuff. Stop trying to look for the Sunday punch. All right. And just got to keep getting by with just little jabs, little jabs, little jabs. All right. An occasional hook. But stop looking for the Sunday punch. All right. That's it for the show. So I'll sum it up. Fed tapered. We lived through it. Markets hit record highs. Investments that typically would do well when the Fed prints dollars, like oil, are down because all of a sudden now the dollar could get stronger. And we've got a lot of things to look at. So I hope you enjoyed this. I hope it helped. I see a heart. Who's the heart from? Steve. Right back at you, my brother. My brother. I'm a little stuffy today. So, yeah, whatever. All right. I'm going to go. I actually have important work to do now. Thank you very much. Peace to you, and I'll see you tomorrow.